The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive deep into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Nadiah. The outlook for fixed income markets in the second quarter of 2025 may just present a cautiously optimistic view driven by a combination of factors. Global interest rates are expected to follow a downward bias supported by a likely 75 basis points Fed fund rate cut starting in June, as the Federal Reserve aims to balance its mandate with economic conditions. In fact, a risk-off sentiment continues to dominate investor behavior, with flows directed towards safe haven assets like government bonds and investment-grade credits. So what's the outlook for fixed income markets? Should investors stay overweight in this market? To find out more, joining me now is Barnabas, Group Chief Economist and Head of Market Research at RHB Bank. Barnabas, welcome to the show.
Yeah, so good day, everybody.
So, Barnabas, how have fixed income markets fared so far? And do you see more optimism driving the markets this year? What are some factors that will be driving this market?
I think we are speaking in highly uncertain and unfortunate times, given that the issues in the markets have been very fluid. But I think generally, given the risk that we are seeing right now, do expect uncertainties to persist. And that basically means that asset allocation should be on the defensive side for global investors. So what we do advocate really is essentially a continued move towards, say, quality fixed income as well as safe haven at this juncture, given that we do not know what's going on and what policies might materialize from the US front in the coming months or weeks. So that basically means that I think perhaps let's stay overweight on selected fixed income, and as well as maybe to have a allocation to safe havens such as US Treasuries and gold. And that is really also very much underpinned by the lower rates that could still materialize into the course of this year. We are still looking for, say, the Federal Reserve to reduce its interest rates by 3 times this year. And if we are looking for, say, a reverse relationship between bond prices and rates, then the lower interest rates would mean that bond valuations will increase in the future, and hence that basically supports the overweight view for fixed income at this juncture.
Right. So diving into the impact of interest rates on fixed income markets, RHB expects the Fed to cut the Fed funds rate by 75 basis points in 2025. How do you think this will impact fixed income markets, especially US Treasuries and investment-grade bonds?
Yeah, so I think that the lower interest rates, it will still benefit demand for fixed income at this juncture. There's two fronts at play. One perhaps is the move away from equities that could mean there may be still further risk allocation, asset allocation into fixed income. That's one. But more pertinent is perhaps the higher bond valuations, as I mentioned just now, that could continue to spur fixed income exposure into this asset class. So with the 3 rate cuts that could happen by the Federal Reserve, that will mean that US Treasury yields may continue to fade further lower, and this is also on the basis of safe haven as well. We do not discount the possibility for US Treasury 10-year yields to fall below 4%, if not lower, and that will actually mean further reinforcement of fixed income demand into the course of this year.
I see. With the Fed's plan to slow down the runoff of its US Treasury holdings, how do you think this will affect liquidity and US Treasury yields in the short term? Are there any longer-term implications for fixed income investors?
Yeah, so I think if we are still on the topic of fixed income, the short-term view, at least at this juncture, could still be negative for fixed income. Why? I think because when there may still be lower valuations or lower price pressures for equities, the entire notion of margin calls as well as profit-taking from various asset classes, to support the equity investments around the world may mean some downside bias for even safe havens as well. But this is on the basis of margin calls, possibly, into the short term. But into the longer term, I think anything can happen. But if we do look for, say, the base case scenario of potentially higher tariffs to 20%, I mean, now that there's a universal tariff of 10% by the US, if we do pencil in probably another 10% after the 90 days postponement of the tariffs, then perhaps there may be another leg down in equities, and that could mean higher demand for safe havens and fixed income into the longer term.
I see. So according to RHB's latest report, over in Asia, Indonesia and Thailand are expected to lower policy rates in 2025. How do you think these rate cuts will affect their local bond markets? What implications do these cuts have for investors in ASEAN government bonds?
Okay, so before we answer on Indonesia and Thailand, we must understand that global investors look at ASEAN as a bloc. And when they look at ASEAN as a bloc, they look at specific economies across ASEAN to, decide which economies to invest in, based on the macro fundamentals, yield expectations, as well as economic expectations into the future. We think that the best bets in ASEAN will remain to be Malaysia and Singapore. The pecking order, Malaysia and Singapore, and maybe Thailand, and last is Indonesia. And that basically will also formulate the fixed income demand into these, economies. Suffice to say, the highest yield remains to be Indonesia, given its policy rate, and then probably the next maybe Malaysia, given where interest rates are. But the thing is that despite the nominal interest rates that we are seeing in Indonesia, above 5% at this juncture, this may not attract as much investor demand given the domestic issues at play in Indonesia. So that is my long-drawn answer to if there is going to be any fixed income demand into Indonesia. Perhaps maybe investors might look towards Malaysia or Singapore for that matter when it comes to investments.
On that note of Malaysia is expected to keep its overnight policy rate unchanged at 3% in 2025. What factors do you believe will contribute to this decision, and how will this impact fixed income investors in Malaysia?
So there has been further official rhetoric in Malaysia for us to glean on, and that basically gives us even more of a reinforcement for our expectations for Malaysia to keep its policy rate at 3%. Yeah, and that means that the economic issues or fundamental issues still remain to be quite resilient within Malaysia itself, for the fact that they can afford to not cut rates as compared to the rest of its ASEAN peers. And that is actually a positive thing for Malaysia, given that there's no need to cut at this juncture. We have to recognize the fact that Malaysia as an economy still remains quite resilient. They have been performing very well towards the course of 2024, and even in the first quarter, there has been signs of further resilience within Malaysia itself, and inflation has been quite tame in Malaysia, very manageable. So I think all in all, if we piece the jigsaw pieces together, we do have an analogy that Malaysia is perhaps a very strong ship, a cruise perhaps, but albeit in choppy waters. So if we look at fixed income demand per se, and even though Malaysia does not cut rates at 3%, that may still continue to spur, fund flows and bond flows into Malaysia, especially given that there is risk aversion and investors may still be looking at safe harbor, and Malaysia could be one of them.
Right. With ASEAN countries like Indonesia, Thailand, and Malaysia experiencing varied fiscal and monetary dynamics, how do you see these dynamics influencing the region's fixed income outlook in 2025, and which markets do you expect to outperform?
Yeah, so if we are looking for industries that may perform better than the rest, then we have to look at what Trump is doing. Essentially, he is doing exclusions for semiconductors as well as pharmaceuticals and lumber, perhaps. And that basically means that maybe these industries that may be relatively unscarce as compared to the rest of other industries that see universal tariffs of 10%. And then from there, we can branch out to which other economies in Asia or ASEAN in particular that has a very high exposure to E&E, semiconductors and pharmaceutical. And some of the countries stand out very strongly. One is Malaysia again, because Malaysia is the sixth largest E&E exporter in the world. And that means that if there is going to be continued exclusion for semiconductors, then perhaps Malaysia stands at the forefront of recovery for this year. Second is Singapore, because Singapore's E&E and semiconductors, manufacturing still remains to be quite strong as well. There's chips, peripheral chips and stuff like that, semiconductors. And also Singapore's pharmaceutical industry is quite strong. Yeah, the biomedical industry is very strong. Yeah, and that basically puts Singapore at the second, probably the pecking order. Last probably is Thailand. Thailand's very strong pharmaceutical, and maybe some of the support from tourism might continue to support Thailand's growth. And that may mean that Thailand will be at the third of the pecking order. Bringing this back to fixed income per se, and that basically means that if you want to look at, say, a quality as well as a resilient payout in terms of yield as well as sustainability into these fixed income bonds, then perhaps investors should look at where the health is, where the prospect is, and where the prognosis is for tariffs spill over to the industries, and where, in which part of ASEAN will these industries perform into 2025.
I see. So on that note, how would you assess the global economic outlook in 2025, particularly with the ongoing trade war and restrictive financial conditions in the US? What potential risks should fixed income investors be aware of in this environment?
So I think that it is important to note that things are very fluid right now. The outlook for this year still remains quite grim. Why? Because we may still be penciling in a base case scenario of another 10% tariff post 90-day postponement that was just recently announced of the tariffs. And that basically means that some further escalation of tariff risk could still be on the cards into the second half of this year. I mean, suffice to say, we have already downgraded our GDP forecast for US to 1.5 with a downside risk to 1%. And within my team, we have been discussing, and that basically also suggests that we are seeing further downside risk for several ASEAN economies as well, if there is further escalation of tariff risk. We are not in a recession camp, I think obviously so. If we do pencil in the probability of recession, probably 20 to 30%, given where it is right now. And this is really on the basis of hopefully that tariff risk escalate into the year. There will be some sense and order, and with negotiations continuing to take hold, that could mean that the growth may be a step down, but not amounting to a recession. So that perhaps may be the positive environment that we are hoping to see for 2025.
Okay, then given the current global risk of sentiment and ongoing trade tensions, do you expect further capital inflows into safe haven assets like government and investment-grade bonds?
Depends on which economies we are referring to. The flows into government and investment-grade bonds has to be backed by the countries or the economies' health and sustainability of its growth. And I think perhaps with safe haven demand, only two countries comes to mind, only two economies comes to mind. First is the United States, because U.S. Treasuries remains to be very well regarded as a safe haven. So that may be a very strong bet as well, especially if yields fall below 4% again for the 10-year yields and valuations pick up. That could be a very strong play into government bonds and the respective investment-grade bonds. That's one. Another economy that comes to mind is perhaps Singapore, because Singapore is very much regarded as the safe haven in ASEAN. Given its very strong fundamentals, its strong trade surplus, as well as its fiscal balance and fiscal standing within Singapore remains very healthy. And that means that, across the other ASEAN economies, given that it's a developed market and very strong balances that's seen in Singapore, the Singapore dollar, as well as Singapore's fixed income, could still be a very good play as well. And maybe to also reinforce Singapore's attractability in the global investors, the yields in Singapore is very much pegged to the US, given that we do not have an interest rate policy. So that basically means maybe a full swing or quite a strong impact to how yields move as compared to the US. And that basically gives investors maybe a little bit more of ammunition to go into fixed income, given that yields might swing quite sharply when US rates fall as well. And that could benefit fixed income.
I see. So, Barnabas, before we let you go, given the multiple cross-currents influencing fixed income markets, such as tariff-induced inflation uncertainty, tariff policy changes, and fiscal austerity, how would you recommend fixed income investors to navigate this complex environment in 2025?
Yeah, so I think in general, investors have to stay prudent, stay aware of the current landscape. It's really hard to predict right now. It's very uncertain. The only certain thing right now is that there will be more uncertainties. Yeah? So I think perhaps with the current landscape, just stay maybe moderately, cautiously optimistic, hopefully. Caution, why? Because there may be more uncertainties, and that could mean an overweight on fixed income, especially selected ones, as I mentioned, and look for probably safe harbor in U.S. Treasuries, if not gold, and maybe perhaps in SGS as well, that could actually play and defend, your portfolio at this current juncture.
I see. All right. Thank you, Barnabas.
Thank you so much.
Thank you. That was Barnabas Gunn, Acting Group Chief Economist and Head of Market Research at RHB Bank. This has been The Wealth Tracker with me, Nadiah Ko.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.